One of the most common reasons businesses fail is lack of funding. So I will share with you some knowledge, secrets and tips that will help your business raise capital. You need to know where do you go to raise capital and how do you convince people to put money in your business. If you are planning to start a business or if you have one already and you need cash to make it grow, then this is for you. As every savvy entrepreneur knows, sometimes you need some extra capital to take things to the next level. It's one of the biggest challenges you'll face. In fact, the most common reason businesses fail is lack of funding. But don't worry, I've got you covered with some knowledge, secrets and tips to help you raise that much needed funding. But first things first, where do you go to raise capital? And how do you convince people to invest in your business? These are the burning questions we'll tackle together. You see, businesses need capital to seize new growth opportunities and adapt to changes. Let's face it, relying solely on existing cash flow could put severe pressure on your business and create unnecessary risks. That's where external funding comes in, giving you the power to scale quickly. But before you approach potential funders, preparation is key. Take a good look at your finances and monitor your financial reputation. Remember, it has a huge impact on suppliers, customers, employees, and funders. So be prepared. Now let's talk funding options. We have two main categories, debt and equity. Debt is when you borrow money from a bank or other financial institution in the form of a loan, which you'll have to pay back later with interest. However, be ready to present a solid plan for paying back the loan, and your lender will likely want to see proof of your ability to generate revenue and manage cash flow. Debt funders want to ensure they get their money back with interest in the time agreed, so they'll require some security in case things go wrong. On the flip side, we have equity, which means it's money invested in your business in exchange for part ownership. Equity financing can be a great option if you're looking for long-term partners who are willing to invest in your vision. However, just keep in mind that giving up equity means you're giving up some control of your business. So it's crucial to find investors who share your values and are aligned with your long-term goals. Most investors will want to own 20 to up to 25% of your company. But hey, negotiations are always on the table. Don't forget. Successful negotiations are all about trying to understand what the other party is thinking. So have in mind that investors will expect to be offered high potential returns to compensate for the risk they are taking. Investors are seeking for substantial financial growth by investing in your business, so they look for the potential of your business. Now let's dive into some ways you can raise capital for your business. The classic method to raise capital is bootstrapping, which means using your own savings or personal assets to fund your business. While this can be risky, it also means that you maintain full control of your business. Did you know that in the early days of Apple, for example, Steve Jobs and Steve Wozniak funded their startup by selling their possessions, including a Volkswagen van and a calculator watch? So if you're struggling to raise capital, maybe it's time to sell that old watch you never wear. Another common way to raise capital is through friends and family. This involves borrowing money from people you know and trust. While it can be a great solution, it's essential to treat it as a business transaction, as you would with any other investor, and have a clear repayment plan in place. But be aware that when things go right, everything is good. But when things go wrong, well, it can seriously damage relationships. And emotional damage can be worse than losing money. So approach it with caution. Crowdfunding is a trendy alternative these days. It involves using online platforms like Kickstarter to gather funds from a large group of individuals. You can offer rewards or equity in your company in exchange for contributions. It's a nice way to engage with the potential customers and supporters. Venture capital is a form of a private equity financing that provides funding to businesses that don't have access to the stock market. Venture capitalists invest money in companies that are looking to expand and have high growth potential. They are professional investors. They are investing other people's money and hope to have a good return on the investment. They invest in early stage startups with a high growth potential in exchange for equity in a company. The downside is that they often require a significant amount of control over the company. Angel investors, on the other hand, are often wealthy individuals, many of whom are entrepreneurs themselves. They invest their own money and they will probably take a more personal interest in your business. Angel investors typically support early stage startups by providing, seed funding and mentorship in exchange for equity. Finding an angel investor can be challenging, but there are many online platforms that connect you with these investors. And now, if you are in the United States, probably in other countries there's some other form. The United States, you've got also access to Small Business Administration, SBA. It's a government agency that offers guidance to individuals who want to start or grow their own businesses. It provides a series of tools on its website to assist both new and established small business owners. The SBA offers a variety of financial resources for small businesses, including micro-lending or small loans that are issued to those who might not meet the requirements for traditional financing. Okay, lastly, there's the IPO, initial public offering, which is when a company goes public and lists its stock on the stock exchange for the first time. It's the initial offer, the first chance the individual investors get to buy parts of a company. The IPO process allows companies to raise capital by allowing the public to own shares. Going public requires careful planning and preparation, but it's an exciting option to consider down the road. Now, when it comes to funding, it's important to find the type that suits you and your potential funder. And remember, even the most successful entrepreneurs faced rejection early on, so don't get discouraged. In conclusion, raising capital can be a daunting task for any entrepreneur, but it's a necessary step for growing your business. With a solid business plan, a strong network, a strategic pitch, prepared finances, and an open mind toward alternative sources of capital, you can increase your chances of success. Now, thanks for tuning in. I'm Maria Mullen, and I wish you the best of luck in your fundraising efforts.